Good morning and welcome to the second day of our sixth East Africa Investor Conference. I'm Daniel Salter, Renaissance Capital's co-head of research and chief equity strategist. During yesterday's macro session, we learned that East Africa is a clear economic outperformer this year, not just within the continent, but also globally. We also learned that for Kenya, the number of COVID cases has been falling in the key cities of Nairobi and Mombasa since mid-July. Traffic in Nairobi is almost back to normal, and recent data is suggesting that the economy has been picking up from the lows which were reached back in April to May. Put together, the IMF was suggesting that these positive trends might be sufficient for them to upgrade their GDP forecasts for Kenya later this year. But what are companies seeing? I'm delighted today to welcome representatives from 4 leading companies from across the region, dialing in today from Nairobi, Kigali, Kampala, and London. We have on the panel Andrew Cohen, the Group Managing Director and CEO of East African Breweries Limited, Desiree Rumanyika, the COO of Bank of Kigali, Nevin Bradford, the CEO of Cipla QSIL, and Edward Kirathe, the founder and CEO of Acorn Holdings. Welcome everyone to the panel. So I thought I'd start off by asking each of you how things are going at the moment, then do a bit more deep dive company by company, if that's okay. Starting off with Andrew, thanks very much for joining us. We've obviously seen the impact of COVID-19 on your business in your full year results, and there are obviously things you can't control here and things you can control. Maybe you could give us a quick update on recent trends since the results, and also tell us something about the Raising the Bar initiative. What is it? How does it work?
Thanks, Daniel, and good morning, everyone. I mean, you're absolutely right. COVID's had a significant impact on the business. In the previous 3 years and the half one of F19, we were growing at double digits, and that growth in half one from a +10 went into significant decline. The main drivers of that, of course, are there's a combination of the lockdown, the social interventions, but also most significantly the closure of our on-trade. It's a majority of our business goes through the on-trade, and therefore there hasn't been the access to our brands that we would traditionally enjoy. What I would say is we've had a few interventions actually. Number one is we've taken a dramatic approach to our cost base. So all our variable costs we've sought to rein back. And we've tried to do that in a way that's a no regret for the future. For example, we've kept our full workforce on. And the reason for that is when we emerge out of the coronavirus pandemic, that we will obviously need to resource the business to get back to the previous levels of growth. But we have taken our variable costs down in other areas. We've cut A&P, we've cut our variable overheads, and we've tried to control our cost base. The second thing we've done is sought to protect our communities. So being an alcohol beverage company, we obviously can produce sanitizer because it's alcohol based. So we've both produced and distributed that. We've also contributed funds to various government emergency charitable organizations in order to help local communities still get access to food, etc. And then the third thing that we've done is we've flexed our routes to market so that consumers can get access to our brands. We've enrolled the motorcycle community across many of our big cities to deliver back direct to home. We've engaged aggregators, online operators who can place those deliveries, and we've repointed our distributors at different routes to market as well. So a combination of flexing our route to market to protect the commercial performance of the business, cutting our costs, and supporting our communities has been how we've intervened.
Thank you, Andrew. Moving on to Bank of Kigali. Desiree, COVID-19, obviously a big issue in Rwanda as it is everywhere, particularly given the importance of tourism and the business conference sector in Rwanda. Could you give us some idea about the extent of the hit that you're seeing on the ground? How much is the government helping support businesses? And how are you positioned at Bank of Kigali?
Thank you, Daniel. Yes, as any country in the world, Rwanda is being hit by the COVID-19. Obviously, by the only fact that we were on lockdown for 3 months, and then we are seeing slowly the business picking up, but especially the tourism sector is still really down. There is no activity at all. If you look at how many hotels were shut down. So, and remember, the government has really invested heavily in the tourism sector by creating the environment for conferences, international conferences, meetings, exhibitions. The government had invested in infrastructure, in security, in setting up a good road network, and government was expecting really to have a great income for the country, but also for the private sector. So to give you a few facts, last year the government got around $80 million from conferences, and this year it was expected to get 90 billion, equivalent roughly to $90 million. And now what is expected is even around zero. So the loss is heavy. I think the bill will be going to be very heavy this year. Looking at how the private sector is being affected, banks obviously also get the hit. So generally speaking, this year the tourism sector will not almost be at sleeping mode. So what we are seeing today as a bank is almost 48% of our book is under payment holiday, to speak, by end of May, because most of the businesses were shut down. They can't do business. Now we are seeing a slight increase in terms of businesses coming back. And now what we are seeing now is almost 20% of our book is under payment holiday. So which means we are seeing some few sectors that are picking up, especially the trade, transport, but still the tourism sector is still really affected. In terms of government interventions, the government has put in place a fund, which they call a recovery fund. It has an initial capital of 100 billion, and it's helping tourism sector to get some working capital, but also to help them to be able to pay banks. So half of it is helping to finance the hotels within the banking sector, which is a good relief for us because they can get a refinancing of 30% of their exposure in the banks and get a rate of 5% from around 16%. It's a good relief. The other part is going into a working capital to help them to be paying some of the operating costs, paying employees and so forth. So the other strategy that the government put in place is to open a liquidity window within the central bank with around 20 billion. But also they reduced the reserve requirement from 5 to 4%, which has released around 20 billion for the banks to be using into financing. So for the bank, if you allow me for 1 minute, we've done a number of things to make sure that we can try to absorb the shock. One of the things we've done is to make sure that we put in place some buffer for bad loans in case some loans go bad, to increase our provisions for the future expected losses. We've also ring-fenced all the loans that are under payment holidays, but also are trying, as my colleague said, to try to cut down the cost, OPEX, and make sure that we try to diversify and try to now focus on non-funded income, so to speak, to try to push our subsidiaries to push more income, more fees from the activities, the insurance, the capital, and other activities. So generally, that's what we're trying to do. We are seeing a lot in terms of digital payments. We are seeing a reduction in terms of cash that we are seeing coming in as before COVID and now. So we're trying to make sure that all these are taken as opportunities for the bank to come up with new strategies to make sure that we stay afloat. Thank you, Daniel.
Thank you, Desiree. Moving on to Nevin. I'm not sure it's possible to have a good pandemic, but Cipla QCIL seems to be perhaps better positioned than others. Can you tell us a bit about how you've managed to adapt to the new environment so quickly? How's your business been impacted?
Yeah, thanks, Daniel. Good morning, ladies and gentlemen. We're a pharmaceutical manufacturer headquartered and based here in Kampala. Whilst nobody or no government and no company, I guess, could foresee the extent and depth of the COVID pandemic. The majority of companies of our size and larger, and indeed smaller, will have business continuity plans already in place, which we were able to adapt and bring into operation as soon as the extent of the COVID situation hit us here in Uganda. Obviously, we were able to provide transport for our staff. We do have company guest houses where we hosted key workers in our facility so that they did not have to travel to and from home during the lockdown. And we were also flexible because we operated under a fairly strict curfew, which initially started at 7 p.m. in the evening. We had to adapt our working patterns to take that into account, of course. Here we also hold the Africa stockpile of malaria medications for the Global Fund, upwards of 2.5 to 3 million treatments at any one time. And we were able to draw down on that stockpile, which was specifically established as an emergency stockpile, obviously not for COVID, but for similar situations to the one we have experienced recently. Overall, no company wants to go through this, but obviously the areas in which we focus, HIV/AIDS and malaria, have not taken a holiday or gone away during COVID. If anything, the demand has increased. What we've seen is that several of our export and partner countries have been unable to source the life-saving antiretrovirals and indeed malaria medications from their normal suppliers. So much so that we've been able to ramp up production, and in the first quarter of our financial year, which was April, May and June, our export business accounted for 90% of our turnover, and our turnover was about 50% up on the previous year-on-year quarter. We've been able to do that because we're a pharmaceutical manufacturer here in the heart of Africa, manufacturing products tailored specifically for African patients, in particular HIV/AIDS, antiretrovirals, and of course malaria treatments. And we have been able to secure multi-million-dollar supply contracts, upwards of $8 to $9 million additional business from countries that have been unable to source these life-saving medications from their normal sources of supply, mainly in India. And throughout this period, we've been able to deliver out of Uganda overland to countries such as Zambia, Zimbabwe, Mozambique. And we also started to export significant volumes of antiretrovirals during this COVID period to South Africa. So it has been a testing period, but as a pharmaceutical manufacturer, the demand has not gone away. If anything, whilst the number of patients has remained stable or will have increased slightly, the supply or the security of supply challenges that some of our countries in the region and further afield have experienced have provided a significant window of opportunity for a manufacturer such as ourselves, that's able to deliver manufactured from Africa to Africa. And overall, whilst of course, as with every other business, we've had significant additional COVID costs, housing costs, PPE costs, sanitizer costs, and the like. The additional business that we've seen coming our way because of our situation and ability to deliver to countries in the region and further afield has meant that the additional COVID costs have actually been significantly overtaken or outweighed by the additional business that we've received and have delivered to date, upwards of $8 million to date in the last 3 to 4 months.
Nevin, thank you. Edward, Acorn Holdings focused on student accommodation in Kenya. To what extent have you had to adapt your business during the pandemic?
Yeah, thank you, Daniel, and good morning, everyone. So COVID has been a mixed bag for us. We have 3 businesses, and each has been impacted differently. So starting, we have the development business, then of course we have the operating properties business, and finally we have the investment management business. So when you look from the development business, it's fortunately been least impacted. we were able to continue our developments and constructions throughout the COVID period. We did that with some help from Guarantor, who are part of our guarantee program in the green bond. So we were able to provide PPEs through some funding through Guarantor to all the construction personnel. This was great actually, because the construction workers on our sites are the most vulnerable part of our supply chain. So being able to support them and to keep them employed during COVID was really, really great. And obviously that means that all our construction projects remain on schedule and have not. Interestingly enough, even the supply chain we thought would be heavily impacted, because we bring in a lot of stuff from places like China and other parts of the world, and even local manufacturing. But what we've seen is that actually it's a demand shock that has come into the market. So suppliers have more inventory, more stocks, and so we are getting better deals than we were getting before. That's been good for us. On the investment side, we've been able to continue on both our equity and debt facilities. We are fortunate to have a deep-pocketed private equity firm backing our business. So that's been fine on that end, and the work we've been doing towards the launch of our REITs has continued, although it was a bit slowed down initially. So that brings us to the third part of our business, which is the operating properties. And there definitely we've had an impact this year. We had to shut for about 3 months, from March to June, when the government closed universities. Having said that, we've seen since reopening in July, the students coming back, and many students, even who have not come back, have chosen to pay the discounted rates we are offering to keep their rooms until the universities reopen. We are seeing a number of universities opening both physically and virtually in September, but we expect the majority will reopen in January. And we expect to bounce back to our pre-COVID full occupancy once they reopen. Fortunately, because we are seeing students returning and paying for their rooms, we will still be able to break even and in fact earn a small operating profit on all our operating properties despite the pandemic. So in summary, a bit of a mixed bag, but fundamentally we keep going.
Thank you, Edward. And I must say, looking at your website, some of the student accommodation is pretty impressive. I speak as someone who at university had a 400-year-old room with no heating and ice on the inside of the window. So, next time I'll go to university in Kenya for sure, given the quality of your accommodation. Moving back now to Andrew at EABL, maybe looking slightly forwards now rather than reviewing where we are to date. Looking at the reopening, clearly things are quite uncertain. In the UK, yesterday we had some tightening of restrictions, but the number of cases in Kenya seems to be on the way down. What are you thinking now about the time frame on bars and restaurants reopening? We're reading about some initiatives, perhaps for the bars and club owners to self-regulate. Do you think that could argue for a faster reopening? What are you thinking there at the moment?
I mean, we've been in live discussions, Daniel, with government on exactly this, and it's the worldwide narrative on lives versus livelihoods. We have to, as we open bars again, we have to do so in a responsible way. I mean, one of the upsides, if there can be an upside in a pandemic, is we haven't stood still whilst this channel has been closed, and I'm very pleased with the new channels that have been developed because they won't go away post-COVID. But you're absolutely right. Bars are critical to our business and also to tourism, to the leisure economy at large, the hospitality industry, etc. So we've been doing a couple of things with government. And you'll have heard Uhuru's announcement a couple of weeks ago about a potential reopening on the 1st of October. And what he basically did was put the emphasis and the responsibility on the shoulders of the industry. Now, what we've been doing during the course of August and September is piloting COVID compliant bars to see how we self-regulate. So there's 2 bars in the central business district of Nairobi, two of the busiest bars in the country, just to make sure we're testing worst case scenario. And we've got PPE, we've got sanitizers, we've got bar staff training on how to serve drinks responsibly and cleanly and healthily. We've got partitioning, we've got social distancing, and we've got posters and education in the outlet. And we're finding that that's working really well. It's a COVID compliant environment, and if we can scale that, if the industry can scale that, then there is the opportunity to open bars in a 2 or 3 weeks time. So that's what we expect to happen in Kenya. There's no guarantees, but cases are down. In fact, one of the things Uhuru said when he made his address a couple of weeks ago was that the WHO, the magic number from the WHO isn't necessarily the number of cases, because you identify more cases with more testing. It's a percentage of infections per case, per 100 cases. And Kenya in particular, in the last 5 or 6 days, has been well below that 5% threshold. I looked this morning, it was 2.5% infection rate this morning. So there is now consistent evidence that we're getting to that criteria of opening up the economy. In Tanzania, nothing was ever closed. I mean, some bars closed voluntarily, but nothing was ever closed. And our Tanzanian business performed exceptionally well in H2 last year and has started very well in July and August of this fiscal. And then Museveni is going to address the Ugandan population tomorrow. I think tomorrow, or it's Friday tomorrow, isn't it? Yes, tomorrow. And the view is that he will probably take a similar approach and a parallel approach with Kenya. So we believe that the conditions are getting to the point where the industry will open up again, but we have a responsibility to put that health and safety at the core of those outlets. And you mentioned in your first question the Raising the Bar initiative. As we closed out last year, we put aside $5 million, 500 million Kenyan shillings, to assist in opening those bars again in a compliant way. So we have funds ready to invest in the sanitization that's required, the PPE, the health and safety training. So, I guess I'm glass half full on this one, but I really feel as though the conditions for a reopening at the beginning of October are upon us.
I think glass half full is very appropriate for your business in any case. You mentioned earlier about efficiency gains and your sort of no regret system of cost cutting. I mean, that point's taken very well. You've managed to cut costs. You've got people working from home. You've got efficiencies in marketing and ad spend, etc. Do you think some of these will be sticky and sustainable longer term, or do you think as things normalize that basically the cost base will revert to and normalize?
No, definitely. I mean, one thing that will happen is the business will normalize again. So nothing's changed about our 2025 strategy. All the conditions for that strategic opportunity are still in place. We've got a bump in the road right now. But one of the things I've been absolutely wowed by is the creativity within the business to identify and eliminate waste. And brewing beer, it's a capital intensive business. You've got a lot of fixed costs up front in the brewery, but costs that we perceived to be fixed, we've managed to make variable, and things like how we resource production in a much more agile way has allowed us to take cost out, and some of that practice will continue post COVID. You also mentioned about A&P. We have reined back on A&P, but one of the things I want to do with the business is flip the shape of the P&L so that we have actually a bigger reinvestment rate in our brands coming out of coronavirus, because we've saved some of these monies that are genuine waste. So I don't just want to send those savings to the bottom line. I want to send those savings back into A&P, back into innovation, back into our workforce, so that we can accelerate our growth when we come out of the pandemic.
Thank you. And you talked a bit about distribution using the boda bodas to deliver beer. That's a pretty cool initiative. I mean, how important do you think these kind of new routes to market, new direct distribution channels could be going forward? Is that something that's also going to stay around? Are you going to be selling more stuff directly, or how will the balance be, do you think?
Undoubtedly. I mean, as I say, the on-trade was the majority of our business, and post-COVID, it will still be a majority of our business, but I suspect a smaller majority. The Boda Boda model, which is the taxi motorbikes in the region, what they were originally employed to do, why they existed, was to carry middle and low-income people to work. Now, given that work has been shut down, people have been working from home, they were effectively rendered redundant themselves. We also had our distributors whose major focus was on distributing beer to bars. Bars were closed, so they were rendered largely redundant as well. And then there's these online aggregators. An example would be Glovo, for example. And these guys take orders online or via the app, and they aggregate. So they'll deliver anything from a 4-pack of beer to a lawnmower, whatever will fit on the back of the motorbike, they will deliver. And what we did at EABL was we triangulated that into a business model. So we brought the border community into a conversation and repointed them from being a taxi service to being a home delivery service, repointed our distributors to home delivery rather than bar delivery, and then used the online aggregators as the facilitator of that order. And it's been absolutely amazing. It's 10x bigger than our entire online business was before we started this initiative. That's not going to go away, and consumers will be able to drink our products at home in the same way that they do in bars. And then the final thing we've done, if you'll allow me, is we've completely replicated our on-trade portfolio in returnable bottles into one-way packs. So you can now get all of our beers in cans. The spirits business has done very well in the off-trade and the take-home business because it's very portable. And so there is genuinely a new channel and a new route to market there that will sustain. And as I say, we will help bars open again with the Raising the Bar initiative.
Sounds pretty cool. I'm saving the hardest question till last. I'd like to get your thoughts on how quickly consumption could rebound. You've obviously got lots of moving parts here. You've got the reopening, how fast that happens. How much pent up demand there might be of people who haven't been out for a drink for some time who might want to have a drink, and then you've got the sort of economic damage and unemployment all in the mix. What are your thoughts there about how the rebound might look?
I mean, the big unknown, Daniel, is the economic damage, or not, as the case may be. I mean, a kind of a dark upside to being in a developing market is, with the exception of Kenya, you haven't really had the fiscal intervention in East Africa that you've had in the US and Europe and the UK, with millions and millions of pounds and dollars being pointed at furloughed people, 80% of the salary funded, all that sort of thing. There simply isn't the GDP depth to be able to do that in East Africa. You've had some VAT and some corporation tax reductions in Kenya, but nobody else has really made those reductions. Now, the last time I experienced a downturn in East Africa, actually it was specifically Kenya, was when we had the two elections in 2017, where between August, which was an annulled election, and October, which was a second election, all economic activity stopped, and PMI, Purchasing Managers Index, went from 54 down to 34, which would indicate that the economy went into significant double-digit decline. And in East Africa, 80% of the population are living on $2 a day, and that's casual work, and so they immediately feel the bite of that. But I still remember back in the November after the election, when the government issued 77 billion shillings back into the counties to rebuild the economy. PMI bounced. It was back up to over 50 within 2 months. So my hope is that we will see in emerging markets like the East African countries that I look after a much more V-shaped recovery than in countries where there's effectively a significant mortgage has been taken out on the economy. So I hope faster rather than slower. And if that's the case, you've also got it's to within the government's benefit, obviously, to have a thriving hospitality industry, because EABL is the second largest contributor to Treasury. We contribute 1% of GDP and 5% to any in-year budget through our excise taxes. So it's in everybody's interest to get the industry moving as part of getting the overall economy moving again.
Thank you very much, Andrew, and we're all very much going to miss our Tusker beer this evening after the conference ends. Thank you. Moving on to Desiree, Bank of Kigali. You told us in the introduction very much about what's happening at the moment. So looking a bit further forward, I think, you know, this crisis has told us a lot about the importance of digitalization, digital banking. You've recently hired a new chief digital officer, a new chief commercial officer. There's obviously a lot happening here. Could you give us some clues about the plans and how might they compare with what the Kenyan banks are doing at the moment in Rwanda?
Thank you, Daniel. I think everything goes back to the year of 2018 when we adopted our digital strategic plan for 3 years, 2020-2021. So from that date, I think we decided to do a lot of things in terms of digitizing the bank from the core, but also trying to digitize all the customer journeys. So what is happening today is just a confirmation of what we started 2 years ago. So we are seeing a high uptake in terms of digital transactions, the banking calls. Our branches are having less and less people coming to queue to do their payments, daily payments. And we're seeing a lot of e-money coming into the bank. On the other side, we're seeing a lot of reduction of cash. Of course, all the costs related to cash manipulation, cash management is going down. So what we started 2 years ago is to build progressively a digital bank by trying to make sure that we do segmentation of our customer base. So customers that are corporate getting their own digital channels, the retail getting its own digital structure, which is tailor-made to their needs. And everything now we're doing is developed in-house. So we've set up what we call a digital factory, whereby we pulled skilled people, engineers, IT developers, designers, agile coaches, so that we can design digital products that suit our customer needs. So as we speak today, I think we are launching soon on the market number of digital products. We are launching very soon our wallet, which is called EcoFee, which we cover or which we address the agricultural ecosystem by allowing farmers to be paying their bills, to be transferring money, to be cashing out. But most importantly, they're able to buy fertilizers, seeds, using their phone, using their small phone, or even using their what you call feature phone, USSD-based technology. So they don't need to have a smartphone. They can use their small phone and do all the transactions they need. So as we speak, we have already onboarded close to 300,000 customers on the wallet, and the objective is to attain new 1 million customers within the agriculture value chain. And the other important thing is to try to make sure that we have already developed a database that give us information on farmers' transaction, on their land, on their fertilizers that they need, so that we are developing agriculture facilities based on their risk profile. So we are able to score their risk, and be able to make sure that we give whatever they can be able to pay back. So everything is developed inside the bank. All the engineers are mobilized. They're young. They are very talented. We give all we can to them so that they can really be able to address all the customer needs. The other aspect is also we are launching before this at the end of this year, next generation internet banking for corporate customers, but also mobile banking next generation for SMEs and retail customers. So the other thing we are doing is we are developing a new core bank system that will allow us to base our decision on analytics and business intelligence. So I can be able to upsell, cross-sell, attract new customers, and basing on all these reports, live reports, to make sure that we increase our uptake in the market. So I think the confirmation today we're having is that we need to push even further to make sure that we address all the sectors, including retail, SMEs, corporate, because today we are seeing, as I said, less and less people coming to the bank. They need to transact from the convenience of their houses, offices, and we are seeing a lot of pressure on our infrastructure. So we need to be ready. We need to have a very strong base whereby we can really be resilient. As I said earlier, we've seen a 20% increase in digital transactions. So, and government now is really taking this opportunity even to make sure that digital payment is becoming mandatory to all businesses. So just a small example, we used to see people in the trading environment coming to queue at the end of the day after they have collected all their income, queue and bank all they got on the day in cash. Now we are seeing people pushing 100 million per day using their phone. So we need to be ready. We need to have our systems ready to have enough security features to make sure that they feel safe, but also to be able to support their transactions. So that's what we're trying to do. We are seeing a lot of happening this year and next year. We are going to be able to acquire at least 1 million customers in the field of SMEs and retail. Thank you, Daniel.
Sounds very exciting. We had a presentation yesterday from Yvonne Mango, our macro economist on the region, and she was saying that inflation has been generally quite well behaved across East Africa during this crisis. But the exception seems to be Rwanda, where inflation is relatively high. Could you talk a bit about that? Is there something different going on in Rwanda to the rest of the region there?
So as you said, I think if you look back to the last 4 or 5 years, I think inflation in Rwanda has been very stable and low compared to other East African community members. It has been even below the average of the East African community members. But recently, I think in the first half of 2020, the inflation for the headline inflation for Rwanda market has slightly increased to around 8.5% from 2.4% last year. And I can maybe call it as something that happened due to very special circumstances. One is the COVID situation. And I think the rise was triggered by inflation from transport, inflation from food, and inflation from energy. So in terms of transport, I think the government has implemented the rising of transport fares so that transport can respect the social distancing, which means that the cost of transport has been increased. But this is a very deliberate decision by the government, which means that it has an impact on the pocket of the population. The other aspect was food. So food I think food was affected by two major aspects. One is food production, local production, which was hit by some weather conditions, droughts, and other conditions. So local production has been poor for the first and second quarter. But the other aspect is an inflation which is imported. Of course, foodstuff, rice, sugar, that were imported, saw a rise in terms of prices. The other effect was also imported from outside because of all the imports, I think, saw the cost of importing being increased because of price to pay to logistics and so forth. So in summary, I think there's a mix of special conditions that we are living in, but also something which is imported from outside. So what I think the government should do is really to continue pushing what they call Made in Rwanda strategy to make sure that we reduce our import bills, but also push for export and make sure that at least we can control the inflation coming outside. We can push food production, but also banks should also invest heavily in the agriculture sector, as the Bank of Uganda has started, to make sure that we stabilize production of foodstuff to avoid importing food and impacting the inflation. But I think bottom line, this is a special condition. If all goes well, I think by end of the projection by end of 2020 is 6.9%, which will be above the average for the East African market. But going forward, I think Rwanda will go back to a very stable inflation status. Thank you.
Thank you. And then final question, again, a tough one, but crises sometimes present opportunities. And as a bank, you're very well capitalized at the moment. Are you seeing some opportunities to acquire perhaps either weaker competitors or expand sideways within the industry in Rwanda or elsewhere? Or are you thinking about paying dividends or buying back shares from the market? Or do you think at the moment it's prudent to try and conserve capital? What are your thoughts on capital allocation at the moment?
I think first of all, we have to pay dividends as soon as the central bank lifts the ban on paying dividends. So we are ready. We have put aside a good buffer to pay dividends for 2019, but also 2020. That's number one. Number two, we are continuing to invest in digital strategy to make sure that we achieve what we planned 2 years ago. We continue to do that. Number three, we are going to continue to grow our balance sheet by trying to finance sectors that we feel are less risky. For information, we have revised our risk appetite to make sure that we balance our risk and deploy capital where we feel it's less risky. So we continue to do that. So in terms of acquisition, I think it's an option on the table. You remember, I think last year we were trying to make sure that we can revamp our insurance arm by acquiring some small insurance companies. It's still on the table. We have the muscle to do so, but we're still discussing if it's the right time, what kind of product insurance company that we should take over. Obviously, it's on the table. The other element of share buyback is also on the table. We are looking at the pros and cons of it. So we have a lot of things that are happening at the same time. Organic growth, of course. But of course, inorganic growth in terms of acquisition, if we get a good opportunity. Thank you.
Thank you, Desiree. Moving on to Sipla QSIL and Nevin. It was good to hear the positive story in your introduction. I think one of the byproducts, if you like, of the pandemic has been the demand for antiretroviral drugs having increased, in particular, some of those used in frontline therapy and HIV. Can you tell us a bit about that, why that's happened, and the impact on you?
Yeah, thanks, Daniel. I think actually the challenge has not been so much that the number of HIV patients or the demand for antiretroviral drugs has increased considerably. The challenge has been to ensure continuity and security of supply for those millions of patients who are stabilized on antiretroviral therapy throughout Africa. Upwards of 90% of the antiretroviral drugs outside of South Africa that are prescribed to HIV patients are imported from overseas. We're one of the major manufacturers in sub-Saharan Africa of antiretroviral drugs and indeed anti-malarial drugs. Now, if you are a HIV patient stabilized on antiretroviral therapy, what's known as the viral load is completely suppressed. In other words, there is no virus, HIV virus, circulating in the blood. Obviously, on the one hand, this means that there is no effect on the body's immune system, but also, crucially as well, the patient is not infected. If antiretroviral therapy is disrupted for a month or 2 or 3, the patient will not get AIDS. The immune system will decline slowly, but the patient will not go from having a near normal immune system to having AIDS in that short space of time. But critically, what will happen is that the patient will become infected from being non-infected. And when we hear about the HIV scourge being eliminated, it is not actually through curing HIV patients, it is actually from stopping the transmission of HIV. And it's the interruption of therapy, and when a patient becomes infected from previously having been non-infected, that is a very serious concern. Several countries in Africa did experience and are experiencing difficulties in sourcing these antiretroviral medicines from their normal source of supply. We manufacture 6 or 7 antiretrovirals, including the 2 or 3 most commonly prescribed first-line therapies, and indeed the new first-line therapy approved and recommended by the WHO, which is a combination of 3 drugs, tenofovir, lamivudine, and dolutegravir. And we're able to manufacture that in quite large volumes. Where we've been able to help out is obviously ensuring continuity and security of supply. We can manufacture here in Uganda and deliver overland to most of Eastern Africa, indeed all of Eastern Africa, most of Southern Africa, and beyond that by dedicated air freighters. So what we've been able to do is help out neighbouring and further afield countries in Africa that have experienced these difficulties in sourcing these life-saving antiretroviral drugs. But moving beyond ARVs, we've been able also to secure continuity of supply for anti-malarial treatments, because basically, as we all know, malaria is an acute condition. If you have severe malaria and you don't receive therapy, then you can be in a very serious situation indeed. Indeed, fatalities can occur and do occur without therapy. We can also guarantee security of supply of that critical life-saving medication as well. And we have done so, quite frankly, throughout the pandemic period, not just in Eastern Africa, but further afield.
So for QSIL, what are your thoughts here? Do you think you could end up as a company playing a greater role now in the kind of critical infrastructure of Uganda and East Africa in general? Is that what you're looking to do after this, to sort of prove and embed yourself further in that critical part of the infrastructure?
Yes, I mean, what we can guarantee is security of supply of these life-saving medications. And in the Ugandan context, for example, at least the Ministry of Health and the government have known that during the COVID period, they will not face any shortage of supply of ARVs or anti-malarial treatments, which must and has been, one of the potential major headaches taken off the table as far as they're concerned. And we've been also able to offer that service and delivery to countries in Eastern Africa as well. So moving forward, we hope this continues. At the end of the day, these are life-saving critical medications, which are sourced and manufactured locally. And we have peer companies in Kenya who are developing the same products. In terms of continuity and security of supply, we do hope it continues. Not much point in importing medicines from 10,000 kilometres away across oceans or by air freight when quality, affordable manufacturers are available in the region.
And we've seen a big pickup in export orders from South Africa, Botswana, Kenya as well. I mean, all countries which have, to a greater or lesser extent, their own indigenous pharmaceutical industries. Why is that? Do you think that change is permanent? Can you keep a foothold in those markets as you've developed in the last few months?
Yes, we can. Our facility and our company is what's known as World Health Organization Good Manufacturing Practice approved. And the products that we manufacture, the ARVs and the anti-malarial, are also WHO pre-qualified. The major donor organizations, such as the Global Fund or the President's Malaria Initiative, who purchase and distribute antiretrovirals and antimalarials, either require the products they buy to be approved by the US FDA or for antimalarials by the World Health Organization. So currently we're actually the only manufacturer in sub-Saharan Africa that's manufacturing this range of WHO pre-qualified medicines, both for malaria and for HIV/AIDS. And it's on the back of this WHO pre-qualification that has enabled us to currently be the only manufacturer, the only African-based supplier to these donor organizations. And these are international tenders where we're competing, with peer companies from India and elsewhere, and competing and winning as an Africa-based supplier. So that is quite a considerable bar to entry from competitors. We hope that more African-based manufacturing companies do obtain this WHO pre-qualification, because it's a little lonely being the only African supplier currently. Competition is a good thing, and the more the better. And it's for that reason that these orders will not dry up. In addition, of course, what we have seen is that because we can guarantee delivery over land, and there have been some issues with supply chains out of India and elsewhere, we have in fact seen the orders placed by these donor organisations increase quite considerably during the COVID period.
So if we look a bit further forward to the bigger picture, what's the next chapter in the CIPLA QSIL story? Are you looking at factories in more countries? Are you looking at different therapeutic areas? I mean, how blue is the sky potentially going forward? I think we may have lost Nevin. Are you on mute, Nevin?
He's on mute.
Sorry, is that okay?
Yep, that's good. Yep, we can hear you.
Yeah, so we're looking at, we hopefully a very blue sky. We're looking at new revenue streams. It's one of our major areas of strategic growth will be moving away entirely from the government or donor-funded side of the pharmaceutical business to entering the retail business here in Uganda. So we've now established a field force and we'll be importing and distributing a range of medicines from manufacturers in India. Heretofore, our business has been primarily, almost entirely, through governments or from donor organisations. So we'll enter the retail private sector here in Uganda. We have a field force of 15 medical representatives now in the field, promoting this range of products. We'll manufacture products in the cardiovascular, diabetes and other fields for the retail market here in Uganda, and possibly as we move forward outside of Uganda as well. In terms of manufacturing, in terms of blue sky, one of the things we are working actively on is to start the manufacture of products for the treatment of oncology for cancer. If we look at the provision of cancer medicines in Uganda, certainly, and indeed to a certain extent in East Africa and beyond, there are either many of the first line or commonly prescribed oncology treatments not available or in intermittent supply. Obviously, if you're undergoing cancer therapy, you require continuity of treatment. It does not help at all if treatment stops and starts and starts and stops. So we are actively looking to develop an oncology franchise, and that will, by the very nature of oncology medicines, which of course are cytotoxic and in some cases poison, but of course they poison the cancer cells and hopefully not the good cells as it were in the body, will require a dedicated manufacturing facility. And that will be in our premise, in our compound here in Kampala. And that's a short to medium term project on which we are liaising with the government of Uganda moving forward. Factories in more countries, it's a possibility. We have had negotiations with one southern African country with a view to establishing a manufacturing facility in that country. The quid pro quo being a guaranteed offtake from that government. We're not there yet, but it's something that's not dead. So it is a possibility. But I think in the short term, what is much more of a possibility and a likelihood is the establishment, as I say, of a second factory in Uganda to manufacture oncology medicines, not just for Uganda, but for the region and hopefully maybe beyond in the sub-Saharan Africa region generally.
Thank you very much, Nevin. Moving on to Edward, Acorn Holdings, student accommodation. I mean, we see Nairobi very much as a regional hub for business. I think Andrew is a very good example of that, and there are numerous other examples of Kenyan companies and international companies using Nairobi as their business hub. Would you say that Nairobi is becoming an educational hub as well for East Africa? I mean, how big could that get? Is this something the government is trying to push, and how involved are you in that?
Yeah, okay, thanks, Daniel. So we accommodate about 20% of our students are international from 53 different nationalities, but the bulk of them are from the East African region, so Uganda, Rwanda, South Sudan, and of course, slightly further afield all the way to Nigeria. Definitely Nairobi is a hub for regional education, especially higher education, but even high school education. You see a lot of students coming from other parts of Africa, so those who cannot afford to go to South Africa or to Europe. And I think it will continue to be so. There is no specific government incentives at the moment for that to happen. But what we think is two things. One is as the cabinet secretary for education is pushing very hard better the institutions to basically improve, and those which can't improve to shut down. So we think the quality of higher education should improve. And obviously, one of the biggest bottlenecks we've had from the universities when we've spoken to them in expanding regional, Nairobi as a hub for education was accommodation. And so, we are seeing that with better accommodation, the universities are now being able to, access more international students. And in fact, recently we saw a college, Boma College, which is part of Boma Hotel. They offer hospitality courses, and they are now partnering with some Swiss hospitality groups. And you could see that being able to partner with us to provide the accommodation is going to really support their program. So in September, they're bringing quite a number of students to us who would not otherwise come without their accommodation. So yeah, I think better quality accommodation is going to mean that there's, Kenya is better positioned to become a hub. And we've seen interest from Rwanda, Malawi, being approached to go and do student accommodation in those markets. So student accommodation is a key part of creating an education hub in any region or in any country.
Thank you. We talked yesterday in our macro panel about the global search for yield and how intense that's likely to get over the next few years. What kind of returns? I know you don't talk about your business on a yield basis per se, but what kind of returns are you looking at? Are you able to achieve in your properties at the moment?
Thank you, Daniel. It depends, obviously, on whether you're looking from the development side to the operating properties. I think when we look at the operating properties, and if you look at where real estate yields are in Kenya, residential yields are in the 4 to 5%, commercial yields are around 8%, and we think we will be more offering yields that are closer to the commercial yields than residential yields. But ultimately, what we see ourselves doing is offering investors a blended return, which should be obviously in the upper teens in terms of when you look at the blended portfolio of development and operating assets.
And on the financing side, you've been a pioneer of green bonds in the sector. I think you told me that your debut green bond had chalked up 7 firsts in the sector, and you've also got plans, I think, to launch a REIT. Could you update us a bit on that on the financing side? What are your plans, and are you financing in shillings, in dollars, and what kind of split between local and international funding are you looking at?
Yeah, so historically, our funding was mostly dollar. And I mean historically, the last 5 years, most of that has been dollar-based, basically equity and debt. We were able to secure a $50 million debt facility from OPIC, which is the private lending arm of the US government some few years ago. So historically, it's been dollars. We have increasingly started moving towards Kenya shilling funding. And in fact, the green bond you mentioned was basically a Kenyan shilling denominated bond, which so far is going really well. We have been able to fund the projects that are ongoing. In fact, that is why our construction projects are on schedule. We've been continuing to draw down on the bond, and we've been continuing to pay the coupons. It does help, as I said at the beginning, to have a strong base of capital, whether it's equity. So we are able, the funding for the coupons for our bond are all funded through the equity that we have put into the project. So the payments for those coupons is available throughout the duration of the bond and is unaffected completely by, what has been going on. So we've actually, been able to continue quite perfectly well with regard to the green bond. With respect to where we go from here, obviously we have indicated to the market that we are launching some REITs. And in fact, we are excited because a few weeks ago we secured a significant investment from an international anchor investor, which is very, very encouraging in terms as we go, and we are soon going to the local market in a couple of weeks, and those should do well because the long-term prospects for student accommodation haven't changed at all due to COVID, and it's a sector that is quite resilient with a quick bounce back. When you think about other real estate asset classes, commercial office or retail or hotels, they are going to have a much more protracted recovery path, as compared to student housing, even rental housing, even from a broader perspective. If you think about that, it's been impacted for sure, but it's short term. It's very short term in nature. So we are hoping to actually close on the REITs, and I think there is no reason we shouldn't be able to do that before the end of the year.
So plenty of untapped demand in Nairobi for student accommodation. What does that mean midterm? Do you have any plans to expand sideways, sector-wise, or indeed geographically? You said you'd been approached by several governments of different countries to consider investing there. What are your thoughts on that?
No, so well, the deficit of student housing is huge in Kenya and Nairobi in particular. We have 550,000 university students in Kenya. We have less than 40,000 beds in the institutions. And so, students today improvise. That's what they do. So the demand is still huge, both in the short to long term. We don't even think, you can kind of meet the entire demand in 10 years. It will take a long, many years. I mean, the UK started purpose-built student accommodation in 1990. That is 30 years ago. They are still meeting pent-up demand today. So it takes a long time, and it's because some of these assets, they take long to build. They are very capital intensive. They are complex. So we don't want to move out of Nairobi before we have built significant scale in Nairobi. What I mentioned is that we have been approached by several entities, not governments, but entities, including universities in Rwanda and Malawi, to go there. Eventually, we may do that, but in the present time, we are focused on trying to build scale in Kenya. But having said that, we definitely are going to go into adjoining asset classes, so rental housing for young people, because ultimately what we are trying to build here at Acon is Africa's premier rental housing business. So we will definitely look at other segments of rental housing beyond student accommodation, and I think next year we will be certainly moving into the young people space at some point in time. So not geographically, but by sub-asset class, yes, we will see expansion.
Edward, thank you very much indeed. And that takes us to 9:33. And I actually think it's quite impressive that we've managed to fit 4 such impressive speakers into 1 hour and 3 minutes. So I'd like to thank all of you very much indeed. Andrew Cowan, Desiree Rumanica, Nevin Bradford, and Edward Kirathe. We have well over 100 investors watching on the 2 platforms, on the website and on YouTube at the moment. So that's an impressive turnout. The video of this session will be available afterwards for anyone who's missed any of it or wants to look at it again. So I'd like to thank everyone very much indeed. Thank you.